The phone lines went dead at 3:47 a.m. London time. Not metaphorically, literally. The largest precious metals dealers in Switzerland stopped answering calls from institutional buyers trying to source immediate delivery silver. By market open in Shanghai, physical silver was trading at an $8 premium to the paper contracts in New York. $8. That's not a spread. That's a chasm. That's the sound of a market structure cracking under pressure that nobody saw coming. While traders were staring at spot prices and debating technical levels, something fundamental shifted in the physical delivery system. The Shanghai Gold Exchange closed Friday with silver at $78.49 per ounce. The COMEX futures settled at $69.85. Do the math. That's an $8 premium for the right to take actual possession of metal in Asia versus owning a contract in America. This discussion is for educational and analytical purposes only and does not constitute financial advice. In 40 years of precious metals markets, premiums of this magnitude have appeared exactly 3 times. March 1980 during the Hunt Brothers episode, September 2008 when Lehman Brothers collapsed, and now. Each time, the premium explosion preceded a structural shift that redefined how the entire commodity sector functioned. Each time, the financial media focused on price volatility while missing the deeper transformation happening in supply chains. But this time feels different. The previous episodes were driven by financial panic or speculative mania. This premium surge is rooted in something more fundamental, something that doesn't reverse when sentiment changes or leverage unwinds. This appears to be driven by physics, by chemistry, by the material requirements of technologies that cannot function without specific elements arranged in specific ways. The $8 premium in Shanghai isn't just a price signal. It's a distress call from an industrial system that has discovered it cannot acquire enough of a material it previously took for granted. While paper markets continue to operate normally, the physical delivery mechanism is showing signs of strain that suggest we've crossed into a new regime. Not a temporary disruption, a phase transition. The kind where the old rules stop working and new equilibrium points establish themselves at levels that would have seemed impossible under the previous system. What makes this moment particularly unsettling is how quietly it developed. No headlines warned that silver availability was approaching critical thresholds. No government agencies issued supply shortage alerts. No major corporations announced production delays due to material constraints. The transformation happened in the shadows of procurement departments and supply chain management offices. Only now, as premiums explode and delivery times extend, does the scale of the shift become visible. The technology driving this transformation has been developing for over a decade. Solid-state battery architecture, the holy grail of energy storage. Every major automotive and electronics manufacturer has invested billions trying to perfect this technology because it promises to solve the fundamental limitations of current battery systems. Faster charging, higher energy density, improved safety, lower weight. The kind of performance improvements that don't just enhance existing products, but enable entirely new categories of devices and vehicles. But there's a catch that most coverage of solid-state batteries glosses over. The chemistry that makes these batteries superior requires silver, not trace amounts sprinkled on circuit boards, substantial quantities integrated directly into the battery's core structure. Silver acts as the host material for lithium-ion deposition, preventing the dendrite formation that causes traditional batteries to degrade, overheat, or catch fire. The silver doesn't just conduct electricity, it becomes an active participant in the energy storage process. This isn't speculation or laboratory theory. Samsung SDI has confirmed specifications for their solid-state production lines, scheduled to come online in 2026. Toyota has announced similar timelines. Volkswagen, BMW, and General Motors have all committed to solid-state technology for their next generation of electric vehicles. The chemistry has been proven. The engineering has been solved. The manufacturing scale-up is underway. What hasn't been solved is where the silver comes from. A conventional electric vehicle uses approximately 30 to 50 grams of silver. Window switches, inverters, charging systems, battery management circuits. The solid-state architecture changes this calculation entirely. Early engineering estimates suggest solid-state batteries require between 100 to 300 grams of silver per vehicle, depending on pack size and performance specifications. Conservative estimates put the requirement at roughly 150 grams per vehicle. The math becomes unsettling quickly. Global automotive production runs approximately 90 million vehicles annually. If just 20% of new vehicles transition to solid-state batteries by 2028, and each requires 150 grams of silver, that represents approximately 27 million ounces of new annual demand. That's roughly equivalent to the entire silver output of Peru, the world's second-largest producer. But 20% adoption may be conservative. If solid-state technology delivers on its promises of 9-minute charging and double the range, consumer adoption could accelerate rapidly. Government mandates for electric vehicle transitions add additional pressure. China has committed to carbon neutrality by 2060. The European Union plans to ban internal combustion engines by 2035. These aren't market-driven timelines. They're regulatory requirements that create inelastic demand for whatever technology enables compliance. If 50% of global vehicle production transitions to solid-state batteries requiring 150 grams of silver each, annual automotive demand reaches approximately 67 million ounces. Add this to existing industrial demand from solar panels, electronics, and traditional automotive applications, and total industrial consumption approaches 800 million ounces annually. Global silver mine production currently runs approximately 840 million ounces per year. The timing couldn't be worse for supply response. Unlike oil or agricultural commodities where production can scale relatively quickly, silver mining operates on geological timelines. Approximately 70% of silver production comes as a byproduct of copper, lead, and zinc mining. Higher silver prices don't directly incentivize new silver mines. They might encourage additional processing of existing ore, but the fundamental supply constraint remains. New mine development requires 10 to 15 years from discovery to production. Environmental permitting, infrastructure development, and capital allocation move at regulatory speed, not market speed. Even if mining companies identified massive new silver deposits tomorrow, those resources wouldn't reach the market until the late 2030s. But solid-state battery production is scaling now. Samsung's pilot lines are already producing cells. Toyota expects commercial production by 2027. The recycling narrative that typically provides supply elasticity doesn't apply effectively to silver. Gold gets recycled at approximately 90% efficiency because it concentrates in jewelry and coins that retain their form and value. Silver gets dispersed across thousands of applications in microscopic quantities. Recovering silver from solar panels or electronic circuits often costs more than the metal is worth. The silver used in solid-state batteries will be locked away for the 15-year vehicle life cycle, unavailable for recycling until the late 2030s. This creates a structural supply deficit that compounds annually. If industrial demand grows by 60 million ounces while supply remains flat, the shortfall must come from above-ground inventories. Exchange warehouses, dealer stockpiles, and investor holdings become the marginal source of supply. But these inventories were never designed to bridge multi-year deficits. They exist to smooth seasonal variations and temporary disruptions. London Bullion Market Association data shows visible silver inventories have declined from over 300 million ounces in 2021 to approximately 155 million ounces by late 2025. That's enough to cover roughly 6 weeks of global demand. Under normal circumstances, such low inventory levels would trigger restocking behavior. But these aren't normal circumstances. Industrial users appear to be hoarding rather than consuming their typical just-in-time purchasing patterns. The Shanghai premium explosion suggests this hoarding behavior has intensified. When physical delivery markets trade at substantial premiums to paper contracts, it indicates immediate possession of metal is valued far above the promise of future delivery. Industrial users willing to pay $8 premiums aren't speculating on price movements. They're securing production continuity. They're acknowledging that silver availability has become more critical than silver cost. Silver lease rates provide additional confirmation of physical tightness. Under normal conditions, borrowing silver for immediate delivery costs approximately 1 to 3% annually. During October 2025, lease rates spiked above 30%. Industrial users paid these extraordinary rates rather than delay production. When manufacturers accept borrowing costs of 30% to access silver immediately, it suggests their alternatives are far more expensive than the financing charges. This combination of surging industrial demand, constrained supply response, depleted inventories, and extreme lease rates creates conditions that historically preceded significant commodity price adjustments. Not speculative bubbles driven by financial excess, but structural repricing driven by physical scarcity. The kind of adjustment where prices reach new equilibrium levels and remain there until supply chains rebalance or demand destruction occurs. The market appears to be repricing silver from a precious metal with industrial applications to a critical industrial material with monetary characteristics. This distinction matters because precious metal demand responds to economic cycles and investment flows. Critical material demand responds to technological necessity and regulatory mandates. Automotive manufacturers can't substitute silver out of solid-state batteries any more than solar panel producers can eliminate silver from photovoltaic cells. The chemistry requires specific elements with specific properties. This technological lock-in creates inelastic demand that persists through economic downturns, financial market volatility, and changing investment sentiment. Even if silver reaches $100 per ounce, electric vehicle manufacturers will continue purchasing because the alternative is not producing vehicles. Even if premiums double, solar installations will continue because renewable energy mandates don't include price exemptions. The psychology of markets during structural transitions tends to follow predictable patterns. Initial disbelief as prices rise beyond historical ranges. Rationalization as participants search for temporary explanations. Acceptance as the new reality becomes undeniable. Panic as late adopters realize the transformation is permanent. We appear to be transitioning from the disbelief phase toward rationalization. Market participants acknowledge silver has reached new price levels but continue expecting reversion to previous ranges. This expectation of reversion may be misplaced if the underlying demand structure has genuinely shifted. Solid-state battery adoption represents a step function change in silver consumption, not a gradual increase. The technology either works and gets deployed at scale, or it doesn't, and demand reverts to baseline levels. The binary nature of this transition creates unusual uncertainty for traditional supply-demand modeling. Historical precedent suggests markets often underprice structural demand shifts until physical shortages force recognition. Rhodium experienced similar dynamics in 2020 when automotive emission standards created step function demand for catalytic converters. Prices rose from $2,000 to $29,000 per ounce as industrial users competed for limited supply. Lithium followed a similar pattern as electric vehicle adoption exceeded supply planning assumptions. The current situation in silver exhibits many characteristics of these historical precedents, but with potentially larger scale impacts. Silver markets are significantly larger and more liquid than rhodium or lithium, which could either dampen volatility through improved price discovery or amplify it through greater institutional participation. The Shanghai premium surge suggests Asian markets are already pricing in tighter supply conditions, while Western markets continue operating under previous assumptions. Physical reality appears to be diverging from financial market pricing in ways that create structural tension. Industrial buyers need metal for production continuity. Financial markets provide price discovery and liquidity. When these functions conflict, resolution typically occurs through price adjustment rather than production delays. Manufacturers rarely shut down billion-dollar facilities due to material costs that represent small percentages of total production expenses. The $8 premium in Shanghai represents more than a temporary supply disruption. It signals that physical silver availability has become a binding constraint on industrial operations. When procurement departments authorize premium payments of this magnitude, they're acknowledging that normal supply channels cannot meet their requirements. This acknowledgement typically precedes supply chain restructuring, long-term contract negotiations, and strategic inventory accumulation that permanently alters market dynamics. What happens when an entire industrial transformation depends on a material that markets still price like jewelry? The question isn't theoretical anymore. Physical silver markets are exhibiting behavior patterns that suggest fundamental assumptions about availability and pricing may no longer hold. The Shanghai Gold Exchange closed December 24th with physical silver at $78.49 per ounce, while New York paper contracts settled near $70. This $8 premium represents more than a regional pricing anomaly. It indicates that immediate possession of metal in Asia carries a valuation premium that reflects underlying physical constraints rather than speculative positioning. Historical analysis shows premiums of this magnitude typically emerge when delivery systems approach capacity limits. This premium structure mirrors patterns observed during previous commodity transitions where new industrial applications created step function demand increases. The difference lies in scale and timing. Unlike historical episodes driven by financial speculation or temporary supply disruptions, current conditions appear rooted in technological requirements that are expanding rather than contracting. Manufacturing commitments already in place suggest this demand profile will intensify through 2027 and beyond. The transformation occurring in silver markets reflects broader industrial realities that extend beyond precious metals trading. Energy storage technologies requiring specific material properties are scaling from laboratory prototypes to mass production. These technologies don't simply use more silver than previous applications. They integrate silver into fundamental chemical processes, where substitution becomes chemically impossible rather than economically impractical. Market pricing mechanisms developed for precious metals trading may prove inadequate for materials that function as critical industrial inputs. When silver transitions from a store of value with industrial applications to an industrial necessity with monetary characteristics, traditional supply-demand modeling requires recalibration. The $8 Shanghai premium suggests this recalibration is already underway in physical markets, even as financial markets continue operating under previous assumptions. The technological foundation driving this transition centers on solid-state battery architecture. Unlike evolutionary improvements in existing battery chemistry, solid-state technology represents a fundamental redesign of how electrical energy gets stored and retrieved. The breakthrough eliminates liquid electrolytes that cause traditional batteries to degrade, overheat, or fail catastrophically. Instead, solid materials handle ion transport while maintaining structural integrity across thousands of charge cycles. This architectural change solves multiple limitations that currently constrain electric vehicle adoption. Charging times drop from hours to minutes. Energy density doubles. Fire risk essentially disappears. Weight decreases substantially. Temperature sensitivity reduces dramatically. These improvements don't represent incremental optimization. They enable entirely new categories of vehicles and applications that current battery technology cannot support. The chemistry underlying these performance gains requires silver to function as more than a conductor. Silver acts as a host material for lithium-ion deposition, preventing dendrite formation that causes conventional batteries to fail. The silver doesn't get consumed in this process, but it becomes structurally integrated into the battery's core architecture. Removing or reducing silver content compromises the fundamental chemistry that enables solid-state performance advantages. Engineering specifications from Samsung SDI, Toyota, and other manufacturers indicate silver requirements ranging from 100 to 300 grams per vehicle, depending on battery pack size and performance targets. These aren't estimates or projections. They represent engineering requirements derived from chemical constraints that determine whether the technology functions as intended. The quantities involved reflect physics rather than preferences. Multiple automotive manufacturers have committed production timelines that suggest solid-state deployment will begin in 2026 and scale rapidly thereafter. Samsung's pilot production lines are already manufacturing cells. Toyota expects commercial production by 2027. General Motors, BMW, and Volkswagen have announced similar timelines. These commitments represent billion-dollar manufacturing investments that create momentum toward large-scale adoption regardless of market conditions. Current baseline silver demand runs approximately 1.1 billion ounces annually across all applications. Industrial consumption accounts for roughly 680 million ounces, with electronics, solar panels, and traditional automotive applications representing the largest categories. Investment demand and jewelry consumption utilize the remaining 420 million ounces. This established demand structure provides context for evaluating additional consumption from solid-state battery adoption. Conservative adoption scenarios assume 20% of global vehicle production transitions to solid-state technology by 2028. With 90 million vehicles produced annually and 150 grams of silver per solid-state vehicle, this represents approximately 27 million ounces of additional demand. Moderate scenarios assuming 40% adoption reach 54 million ounces. Aggressive scenarios approaching 60% adoption require approximately 81 million ounces annually. These demand increases compound existing growth in traditional silver applications. Solar panel installations continue expanding under renewable energy mandates. Electronic device production grows with global economic development. Traditional automotive silver consumption increases as vehicle production recovers and electrical content per vehicle rises. The solid-state transition occurs alongside these established trends rather than replacing them. The timing of demand emergence creates additional pressure on supply systems. Unlike gradual demand growth that allows supply chains to adjust incrementally, solid-state adoption follows technology deployment curves, where change accelerates rapidly once commercial viability is established. Manufacturing commitments already in place suggest demand will emerge faster than historical commodity transitions, where market forces could moderate adoption rates through price signals. Global silver mine production currently runs approximately 840 million ounces annually, with modest growth rates constrained by geological and economic factors. Approximately 70% of silver production occurs as a byproduct of copper, lead, and zinc mining operations. This structure means silver prices alone cannot incentivize significant supply increases, since production decisions depend primarily on base metal economics. New mine development requires 10 to 15-year timelines from discovery through permitting to commercial production. Environmental regulations, infrastructure requirements, and capital allocation processes operate on regulatory schedules rather than market timelines. Even if mining companies identified substantial new silver deposits immediately, those resources wouldn't reach markets until the late 2030s. Solid-state battery demand emerges in the mid-2020s. Existing mines face declining ore grades that require processing larger quantities of rock to extract equivalent silver content. Energy costs, labor expenses, and environmental compliance requirements continue rising while ore quality deteriorates. These trends suggest maintaining current production levels requires increasing investment and operational complexity, even without attempting to expand output. The $8 premium in Shanghai reflects a reality that extends far beyond precious metals trading. Industrial systems designed around assumed material availability are discovering that assumptions don't guarantee supply when physics imposes constraints. The transformation isn't reversible through market mechanisms or policy adjustments. Manufacturing commitments have already locked in demand trajectories that exceed geological production timelines. Silver markets are experiencing what happens when critical materials transition from abundant to scarce within industrial systems that cannot function without them. The premium explosion signals that physical availability has become a binding constraint on production continuity rather than a cost consideration. When procurement departments authorize $8 premiums for immediate delivery, they acknowledge that normal supply channels cannot meet operational requirements. This acknowledgement typically precedes fundamental restructuring of how materials get sourced, priced, and allocated across industrial applications. The Shanghai premium isn't temporary market friction. It represents the emergence of new equilibrium conditions where physical possession carries valuation premiums that reflect underlying scarcity rather than speculative positioning. Historical precedent suggests these transitions accelerate once physical constraints force recognition. Rhodium, lithium, and rare earth elements all experience similar dynamics when new industrial applications created step function demand increases. Silver markets exhibit the same structural characteristics, but with potentially larger scale implications given the breadth of applications and the scale of technological deployment already committed. The solid-state battery transition represents more than technological evolution. It demonstrates how chemistry and physics ultimately impose limits on policy preferences and market expectations. When industrial systems require specific materials with specific properties, substitution becomes impossible regardless of price levels or regulatory mandates. Physical reality has already begun influencing procurement decisions, supply chain strategies, and manufacturing investments, even as financial markets continue pricing silver as if previous supply assumptions remain valid. The $8 premium in Shanghai suggests this divergence between physical constraints and financial pricing may be permanent rather than temporary. When industrial necessity collides with geological limitation, physics typically determines the outcome.